Welcome to Breaking News to Trading Moves. Today we're looking at an acquisition that really serves as a great illustration of a very successful, very repeatable strategy in the industrial sector. It's one that touches everything from defense spending to, the long-term cost of flying.
That's right. The main event we're analyzing is the recent agreement for TransDigm, that's ticker TDG, to acquire Stellant Systems.
Okay.
The seller is Arlington Capital Partners, and the price is set at about $960 million in cash.
All cash.
All cash. And it's worth noting right up front, that figure actually includes certain tax benefits that are factored into the value TransDigm is getting.
Okay, so before we get into the strategy and the motives, let's just establish what Stellant Systems really is. For you, the listener, who maybe doesn't track every single specialized component provider, what's the business here that's worth almost $1 billion?
Well, Stellant operates in a very high-tech and specialized corner of the market. They design and manufacture high-power electronic components, subsystems, really.
Right.
These are not parts you'd find in, consumer electronics. They're highly specialized, extremely reliable systems for platforms where failure is, well, it's just not an option.
Can you give us some examples? Where would we find their products?
Absolutely. Their components are used across a really critical spectrum. We're talking aerospace, high-end defense platforms, space technology, advanced satellite comms systems.
So really demanding environments.
Extremely demanding. Think of ruggedized parts that manage power or enable critical communications in, say, a deep space mission or advanced fighter jet's radar system. Their position is so strong because they're embedded in these mission-critical programs.
They're not making the screws, they're making the brains.
They're making the brains and the muscle, exactly. The parts that power the most critical functions.
So what we have is a major aerospace player, TransDigm, paying nearly $1 billion in cash for a very specialized electronics firm. So our mission here is to really explore the thinking behind this deal. And then we'll get into the specific groups, the companies, customers, competitors who are set to benefit, and maybe those who are going to face some tougher conditions because of this consolidation.
A comprehensive look is essential. Before we can really call out winners and losers, we have to get into the financial geometry of the deal and, confirm it lines up with that well-known TransDigm strategy.
All right, let's do it. The specifics. As we said, $960 million, all cash. The fact that it's all cash funded, without the heavy leverage TransDigm is sometimes known for, that seems noteworthy.
Oh, it absolutely is.
Yeah.
A cash deal of this size tells you a couple things. First, the health of TransDigm's balance sheet is obviously very strong.
Sure.
But second, and maybe more to the point, it signals their immense confidence in the cash generation of Stellant, both immediately and long-term. They believe in this asset so much that they didn't even want the complexity of external debt. They see it as an instant cash cow.
And they're willing to pay a premium for it with their own money.
Exactly.
Speaking of that premium, let's look at the metrics. What's Stellant's revenue looking like?
So, based on the projections, Stellant is expected to generate about $300 million in revenue in 2025.
Okay, so a quick calculation there. $960 million for $300 million in revenue. That's a multiple of what, 3.2 times?
Roughly, yes. And while that might seem a little high for some industrial businesses, for TransDigm, it's less about the top-line revenue number and much more about the composition of that revenue, where it comes from.
Okay, so let's break that down. You mentioned proprietary products and aftermarket sales. Let's get specific on that.
Right. There are two non-negotiable items for TransDigm, and Stellant just checks both boxes perfectly. First, about 50%, half of Stellant's revenue is from aftermarket sales.
50%?
50%. Maintenance, repair, replacement of parts already out there on planes and defense platforms. That revenue is recurring, it's high margin, and it's exceptionally predictable.
That model basically guarantees revenue for decades to come, doesn't it?
It does. It's like the razor and blade model, but for platforms that cost hundreds of billions of dollars. Once that Stellant part is on the plane, TransDigm owns the aftermarket for the next 20, 30, maybe 40 years.
Okay, that's the first key point. And the second?
The second is the proprietary nature of the products. The vast majority of their revenue, we're talking well over 80%, comes from sole source or proprietary parts. That right there is the golden ticket. That's what justifies the $960 million in cash.
Let's really clarify what proprietary means in this context. I mean, for a lot of people, electronics seem interchangeable. Why is it so hard to just substitute a Stellant part?
That's a great question. When we say proprietary here, it's not just about a patent. It means Stellant is either the only manufacturer or they have this unique combination of IP, the specialized manufacturing tools, and this is crucial, the intense regulatory and military approvals needed to make the part.
Ah, the approvals.
Yes. For a defense platform, you can't just swap out a high-power electronic system with some generic off-the-shelf component. It would require complete requalification, retesting, probably a redesign of the whole system it plugs into. The cost of the component is tiny compared to the platform, but the cost to switch suppliers is just astronomical.
So if you're a big defense contractor and a Stellant part on your platform needs a repair, you are basically locked in. There's no easy way to go around TransDigm now.
That is the commercial reality they're buying, yes.
Yeah.
We've mentioned radio frequency or RF systems for radar. We're talking high-power energy management. And these ruggedized components that can handle incredible shock and temperature changes. The technical barrier to entry is just massive, and that translates directly into pricing leverage.
So they're buying predictability and pricing power.
For decades to come.
That sets us up perfectly to look at the buyer. Let's get into the TransDigm playbook, ticker TDG. I mean, this acquisition seems like it was just made for them.
It is a textbook case study. TransDigm's entire success is built on two, let's call them pillars, for acquisition, and Stellant hits both of them flawlessly.
Okay, pillar one.
Pillar one is acquiring proprietary components. They systematically go after companies that make parts that are hard to replace. That minimizes competition. It's all about gaining leverage over your customer, whether that's the government, a prime contractor, or an airline.
They don't want the commoditized stuff. They want the one-of-a-kind, indispensable part.
Exactly right. They look for essential components where the failure of that part would be catastrophic for the entire mission or aircraft. This creates a situation where the customer's demand is inelastic, which gives TransDigm a lot of pricing flexibility.
And pillar two has to be the revenue engine, the aftermarket.
That's the long-term guarantee. TransDigm loves assets where sales are predictable and recurring long after the initial plane is sold. And Stellant's 50% aftermarket figure is just undeniable proof that this deal fits. Those parts have to be maintained, repaired, replaced for the entire life of the platform.
That makes their whole business model incredibly resilient, right? It protects them from the ups and downs of new aircraft orders.
Precisely.
I do wonder, though, how they balance this. I mean, these are defense electronics. They're tied to national security. Doesn't TransDigm have to worry about pushback from, say, the Department of Defense or the big OEMs who are getting more and more concerned about supplier monopolies?
That's a crucial point, and it's one they manage very carefully. If you look at their history, they seem to understand where the lines are. Their pricing is disciplined, yes, but they operate in a highly regulated world.
So the risk isn't the deal getting blocked.
Less that, and more about scrutiny on their pricing practices after the deal closes, especially on parts essential for defense readiness. But at the end of the day, the technical barriers, the sheer cost to requalify a new supplier, that usually gives TransDigm the upper hand.
Okay. And this deal also fits into a bigger picture, a broader market trend.
It does. The external factor here is, the current geopolitical climate. There's a lot more investment going into defense modernization and space technology right now. So this deal increases TransDigm's exposure to those exact markets. Demand for these high-power, ruggedized electronics is rising, and it's supported by long-cycle government spending programs.
So TransDigm is making a strategic bet here. They're betting on continued strength in defense and space spending, which also kind of hedges them against any potential softness in the commercial airline world.
It's a very deliberate rebalancing, yes. But even with this great strategic fit, we have to look at the financial side closely. As we said, it's all cash.
Right.
And while avoiding debt is good, the size of the cash outlay plus Stellant's current operating profile, it could mean the deal is actually margin dilutive for TransDigm, at least in the short run.
Wait, that seems backward. Why would a textbook acquisition like this, with all these proprietary parts, possibly lower their overall margin?
It's just a function of the math. TransDigm as a whole operates with incredibly high margins. They're the gold standard in the sector. If Stellant's current margin profile is lower than TransDigm's average, and it most likely is, then when you combine them, the new consolidated average will mathematically dip down, temporarily.
Ah, I see. So the goal isn't just to buy it, it's to quickly bring Stellant's performance up to TransDigm's level.
Exactly. The return on that $960 million depends almost entirely on two things after the deal closes. First is integration. Can they merge operations efficiently, streamline things, and get those cost savings quickly?
And the second factor, I'm guessing, is the core of their philosophy.
It is capitalizing on pricing power. The whole reason for the deal rests on TransDigm leveraging the proprietary nature of Stellant's products to optimize pricing and bring that unit's margins up to the group average over time. That's their core competency.
That detailed look at the strategy sets the stage perfectly for our main goal, figuring out the winners and the companies facing new pressure. Let's start with the beneficiaries. Who are the clear winners here?
Okay, our first category of winners would be the aerospace components, consolidators and suppliers with pricing power.
So the idea is that this deal validates their whole business model.
Precisely. This transaction is a loud and clear affirmation of the strategy. Consolidate niche components and monetize the aftermarket. When a giant like TransDigm successfully does this, paying a premium for a quality asset like Stellant, it sends a powerful signal to the markets.
And what's the actual impact of that signal?
It generally leads to an upward re-rating of valuation multiples across the whole group of companies that share this model. Investors see TransDigm doing this over and over again, and it suggests the entire sector deserves a premium valuation because the model is so durable. And of course, it always starts up M&A speculation again.
Okay, so who are the specific names that get a lift from this?
Well, TransDigm, ticker TDG, is the obvious direct beneficiary. They've just added another fantastic asset. But we also have to look immediately at their key peer, HIICO, ticker HEI.
Now, why would 8AIC, a direct competitor, benefit from a TransDigm deal?
Because they run a very similar playbook, focusing on proprietary parts and the aftermarket, mostly in the commercial space. When TransDigm validates the profitability of this model by paying a high multiple for Stellant, it strengthens the whole story for HAICO. Their valuations are often benchmarked against each other. It confirms the thesis for the whole group.
Moving on to the second category, the beneficiaries tied more to the technology itself, defense electronics and mission-critical connectivity providers.
Right. Stellant's specific focus on high-power electronics tells us a lot about where defense spending is heading. It highlights this structural theme of increasing electronic content.
It's less about the metal and more about the circuits.
Exactly. The industry is moving toward platforms where advanced electronics, often software-driven and very specialized, are the main cost driver. We're talking about those RF systems for radar and comms, power systems, rugged computing, all of it.
So who's best positioned to ride that wave?
We can look at companies that provide the essential architecture for all this connectivity. Amphenol, ticker APH, is a key one.
Okay.
While Stellant makes the subsystems, Amphenol makes the specialized connectors, cables, and sensors that make those systems actually work. As Stellant's markets grow, so does the demand for the high-reliability interconnects that Amphenol provides.
And who else is in that space?
TE Connectivity, ticker TEL, is another one to watch. They also benefit from this growing need for ruggedized systems and advanced electronics in these demanding markets. The Stellant deal just shines a spotlight on all the high-quality suppliers in this niche.
Okay, our third category of winners is broader, the entire U.S. aerospace and defense supply chain.
Yes. If the market reads this deal, $1 billion in cash, as a clear sign of strong, sustained demand in defense and space, it acts like a barometer for the whole industry. It suggests long-term budget stability.
And who, specifically, within that huge supply chain benefits most?
Primarily, companies focused on upgrades, sustainment, and parts for these long-life platforms, because that's where the aftermarket is crucial, which, as we've said, is half of Stellant's business. Reaffirmed aftermarket demand means stable, long-cycle revenue for all the suppliers in that ecosystem.
Let's name a couple of those parts producers.
Howmet Aerospace, ticker HWM, is a major one. They make advanced engineered parts for engines and airframes. They don't make electronics, but robust sustainment spending is a direct tailwind for them. It guarantees long-term demand for their replacement parts.
And what about a more specialized tech player like Teledyne?
Teledyne Technologies, ticker TDY, is very relevant. They have a lot of exposure to specialized defense segments, including digital imaging and instrumentation. The TransDigm deal just reinforces the idea that high-tech defense content commands premium valuations, which supports the story for a company like Teledyne.
We've laid out the positive side pretty thoroughly. Now let's pivot to the inverse. The potential losers, or at least the groups facing new challenges because of this.
Our first and maybe most impacted category would be the customers themselves, airlines and aircraft operators.
And the core issue here is just basic supply chain leverage, right? More consolidation means more pricing power for the supplier.
That is the direct and frankly painful consequence. When a company like TransDigm, whose entire model is based on maximizing returns from proprietary parts, adds more sole source assets to its portfolio, the competition for those parts just shrinks further.
And how does that actually hit the airlines who are always working on thin margins?
For them, it means parts inflation directly pressures their maintenance, repair, and overhaul, or MRO costs. MRO is already a huge operational expense. So if the price for an essential electronic part goes up because of this consolidation, it's a constant headwind against their margins. And it accrues over the entire life of the aircraft.
A multi-decade cost creep. So which airlines are most exposed?
Well, all of them are, but especially those with large, mature fleets that need a lot of maintenance. So a company like Delta Airlines, ticker DAL, with its big, complex fleet, will absolutely face pressure from these increased supplier costs over time.
As parts age, they have to pay the new, higher price.
They do. And it's the same for a peer like United Airlines, ticker UAL. They're just as susceptible to this component inflation. The bottom line is, when a supplier gets sole source control, the customer's negotiating power drops, often to zero.
Okay, let's move upstream to category 2. The OEMs, the big aircraft manufacturers. They need a competitive supply chain to manage their own costs.
And that's exactly where the challenge is. When suppliers of critical subsystems like Stellant consolidate, it changes the whole negotiating dynamic for the OEMs. Their goal is a diverse supply base to keep prices down. Consolidation works directly against that.
And what are the specific impacts on an OEM's business?
It's a few things. First, they face tougher negotiations, which can lead directly to higher input costs for them. And second, there's a risk of delays. If the newly consolidated supplier is more focused on optimizing margins than expanding capacity, it could create bottlenecks for the OEM's production line.
We have to talk about Boeing, ticker BA here.
Boeing is the prime example. As a massive integrator, they depend on competitive pricing from their supply base. When more and more critical parts fall under the ownership of a disciplined consolidator like TransDigm, Boeing's ability to negotiate costs gets squeezed. They're locked in.
And what about someone like Spirit Aerosystems, ticker SPR, who's a major supplier to Boeing?
Spirit faces indirect pressure. They make big airframe structures, but they still have to buy their own subcomponents. So if upstream consolidation drives up the price for a specialized electronic part they need to install, Spirit's own cost structure gets worse. It's a squeeze from all sides.
All right, our final category of losers is the most direct one. The other aerospace and defense component makers who now have to compete with an even bigger TransDigm.
Right. And this creates a double challenge for them. First, TransDigm's expanded product coverage just increases the competitive pressure everywhere. They have new capabilities now in defense electronics and RF systems, so the field of sole source suppliers shrinks, and TransDigm's shadow just gets longer.
Making it harder for the smaller guys to win new business.
Exactly. When an OEM is looking for a new part, a giant integrated supplier like TransDigm is a very compelling and very hard to ignore option.
And the second part of the challenge, the M&A market itself.
Yes, that $960 million price tag is an immediate benchmark. It raises the price for any future acquisitions in this space. If a smaller competitor was eyeing a similar asset, they now know the price floor has just gone up. It makes it much harder for anyone else to compete with TransDigm's scale and cash.
Let's name a couple of competitors that are affected here.
Crane, ticker CER, comes to mind. They're a diversified components maker. They now have to face an even larger, more dominant player. They'll have to work even harder to defend their own unique niches.
And Atkore, ticker ATKR.
Atkore is part of that broader ecosystem where the competitive dynamics are just getting tougher. The big takeaway is that the willingness to pay a premium for proprietary technology raises the stakes for every single manufacturer in this world.
This breakdown of winners and losers gives us a really clear picture. Let's move to our final section. What you, the listener, should be tracking to monitor how this all plays out. What are the headlines we should be watching for?
The first, most immediate thing is just the deal mechanics. We need to watch for the official closing time and any regulatory conditions. Given Stellant's defense work, any prolonged review could create some uncertainty.
And after it closes, what are the internal metrics that will tell us if TransDigm is executing well?
We need to listen closely to what management says about margin dilution. We talked about that near-term compression. The real test is how quickly they can integrate Stellant and get those margins moving up toward the TransDigm Group average. That's the ultimate justification for the price they paid.
And finally, the impact on future M&A.
That's a huge indicator. We need to see if TransDigm stays active in the market after this. If they follow this up with another deal, it confirms their acquisition engine is still running at full speed, and that could influence the valuation of the entire sector even further.
Okay, to tie this all together, let's look at this through a quick trading lens. Based on everything we've reviewed, what's the bull case? The best case scenario for TransDigm?
The bull case is all about flawless execution. TransDigm integrates Stellant smoothly, they apply their famous playbook, and they expand margins quickly through pricing and efficiencies. And crucially, the underlying defense and space markets stay strong, giving them a favorable environment to operate in.
And the bear case, the more challenging scenario.
The bear case is about execution risk and market headwinds. The margin dilution gets investor scrutiny. Maybe the synergies don't materialize as fast as they hoped. And then on top of that, a general slowdown in commercial air travel could pressure the rest of their business, even if the defense side holds up.
That gives us a really clear framework for watching this. Before we go, let's leave our listener with one final thought, something to consider that builds on this idea of consolidation.
Consider this. The leverage that suppliers like Stellant, now under TransDigm, have. It isn't just about today's pricing. It's about control over future technology. And this level of consolidation might just force the big buyers, the OEMs, the defense agencies, to fundamentally rethink their risk.
How so?
Well, will they start to prioritize supplier diversity over specialized expertise when they're planning new programs, specifically to avoid this exact pricing leverage down the road? The industry might be getting close to a tipping point where the cost of consolidation forces a strategic redesign of how supply chains work over the next decade.
That's a powerful thought to end on as the industry moves forward. Thank you for joining us for this analysis.
My pleasure.
Before you go, we must provide our mandatory statement. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thank you for tuning in to Breaking News to Trading Moves. We hope this exploration helps you track the market effectively.